Welcome back to MarketSnap, your daily rundown of everything that moved the markets. Today was a session of two halves, with the S&P 500 and Nasdaq pulling back from record highs, even as the Russell 2000 pushed to fresh 52-week peaks. But the real story? It's the tension building beneath the surface, between cooling inflation data and a bond market that's screaming about fiscal risks. We're going to unpack that disconnect, why a 9% surge in a Brazilian fintech might be telling you more about risk appetite than you think, and the AI trade that's starting to show some cracks. Let's get straight to the tape. The Dow slipped about 0.2%, the S&P 500 gave back 0.17%, and the Nasdaq dipped 0.28%. But here's the interesting part. The Russell 2000 bucked the trend, climbing 0.5% to hit a fresh 52-week high. That's a classic risk-on rotation signal, and it tells us the rally is broadening out beyond megacap tech. Meanwhile, the VIX dropped another 2.6% to sit just above 14, which is remarkable given the geopolitical backdrop we're about to discuss. The S&P 500 is coming off a week where it notched another all-time high, driven by cooler-than-expected inflation prints. The CPI came in right at expectations, and the PPI was completely flat, which took a September rate hike almost entirely off the table. But here's the catch. The index is now trading at a level where profit margins are at record highs of nearly 17%, and that's the fuel behind this rally. The question is whether that fuel lasts. Now let's talk about the movers that really caught our attention. New Holdings absolutely stole the show, surging over 9% on the day. That's a massive move for a company of that size, and it signals that investors are still hungry for high-growth fintech stories. We also saw SanDisk extend its monster rally up another 7% after a string of bullish analyst calls following their investor day. AMD climbed 6.5%, and Nebius, the AI cloud player, jumped nearly 9% on continued momentum. But for every winner, there's a loser. Broadcom tumbled nearly 6%, and Applied Materials dropped over 5% after their earnings failed to dazzle Wall Street. Oracle slid almost 4%, and Cloudflare gave back 4.5%. This is the AI trade bifurcating. The picks and shovels players that beat expectations are getting rewarded, but the ones that show any sign of weakness are getting hit hard. Zooming out to the weekly picture, the rotation story gets even clearer. Marathon Petroleum and Phillips 66 are up 20% and 15% respectively, riding the oil price surge we'll get to in a moment. Workday gained 18% on the week after strong earnings and a private equity bid for a peer. And CoreWeave, the AI cloud company, is up 19%, though we should note that its free cash flow situation remains deeply negative. On the flip side, Tapestry got crushed, down over 21% for the week. First Solar fell 13%, and JD.com dropped over 10%. It's a mixed bag, but the pattern here is that high multiple growth names without clear near-term catalysts are getting repriced. Now let's talk about the elephant in the room, oil and geopolitics. The Strait of Hormuz remains effectively closed, and the U.S. has threatened an indefinite naval blockade of Iranian ports. Treasury Secretary Bessent is promising economic measures on Iran that have never been seen. This is pushing Brent crude toward $88 a barrel, and it's creating real supply concerns. Asian refiners are scrambling to buy U.S. crude as an alternative, and Turkey has slashed Russian oil imports due to Black Sea disruptions. Here's what matters for your portfolio. Jeremy Siegel made a great point today. If oil stays near $80, there's no way the Fed raises rates in September. But if it keeps climbing, all bets are off. The market is currently pricing in a hold, but the 30-year Treasury yield just hit 5.2%. The highest since 2001. That's a massive red flag. The bond market is telling us that inflation risks are not dead and that the fiscal situation is deteriorating. Speaking of inflation, the University of Michigan Consumer Sentiment Survey took an unexpected dip in August, ending 2 months of improvement. The drop was driven largely by Republican sentiment, hitting a 2-year low, which tells you how much politics is now driving economic perceptions. We also got weak retail sales data, down 0.6% in July, the first decline in 14 months. But before you panic, the details matter. Cheaper gas and an Amazon Prime Day hangover explain most of the weakness. The bigger structural story remains the national debt. We're about to hit $40 trillion, and Bank of America's Michael Hartnett thinks we'll see $50 trillion by 2029. That's why long-term yields are climbing even as the Fed holds rates steady. For long-term investors, this is the backdrop you need to understand. It's why gold and other hard assets have been performing well, and why the 60/40 portfolio is facing headwinds from the bond side. Let's check in on the mega caps. Nvidia was basically flat, which is notable given the volatility in the semis today. Apple eked out a small gain. Tesla was up slightly on rumors of a flying car reveal at SpaceX's Texas facility. But the real story is Bill Ackman. He's back in Netflix and Visa, and those stocks jumped on the news. Ackman called his own fund's stock price frankly absurd earlier this week, and he's putting his money where his mouth is. There's also a fascinating debate happening about AI capital spending. The Magnificent Seven are projected to spend over $2 trillion on AI infrastructure, and analysts are questioning whether Wall Street can even fund half of it. Amazon leads the pack with $220 billion in projected capex. Meanwhile, Meta's free cash flow dropped 91% year over year, and Alphabet and Oracle are posting even larger negative cash flows. The AI build-out is real, but the monetization question is becoming impossible to ignore. On the trade front, the White House announced 100% tariffs on drones to protect national security and bolster domestic supply chains. That sent drone stocks soaring. Unusual Machines jumped 22%, and Red Cat climbed 8%. There's also a new report estimating that illegal transshipment, mostly from China, is costing the U.S. between $19 and $26 billion in lost tariff revenue annually. The administration is cracking down, and a federal trade court just upheld the closure of the de minimis loophole. Looking ahead to next week, we've got some important earnings on the calendar. Walmart headlines the retail reports, and given the weak retail sales data, all eyes will be on their guidance. We'll also hear from JD.com, which has been under pressure despite reporting measurable progress on AI monetization. And Birkenstock, Wendy's, and a host of international names will report. The Fed minutes from the last meeting will also drop, and given the rate hike debate, those will be closely scrutinized. You can find exclusive earnings transcript summaries on MarketSnap. Let's wrap up with the sector action. Energy is the standout performer this week, up over 4% on the oil surge. Technology is up 2.3%, and healthcare has gained 1.3%. The laggards are basic materials, down slightly, and consumer cyclical, which is feeling the pinch from weaker retail data. One final thought for the long-term investors out there. The market is hitting record highs while